Hello dear students. As we discussed in our tutorial 6, the concepts of capital structure, financial leverage and trading on equity. Now here I am going to show you an example how the use of debt fund in capital structure help in leveraging, that is help in increasing earning per share. When the use of debt fund in the capital structure able to increase earning per share, it is called a situation of favorable financial leverage. And if it not increase as expected, or rather it lead to decrease in earning per share, that is a situation which is called unfavorable financial leverage. The favorable financial leverage, the situation of favorable financial leverage, that is also called trading on equity, because by using the cheaper source of fund, that is debt fund, the shareholders, they able to increase their earning per share, because they are using in the organization they are using a fixed financial charges security, that is the debt fund. So let's begin. Now these are the hypothetical figures I have taken for the example. Total fund use is 10 lakh, interest rate 10% per annum, tax rate 30%. Earning before interest and tax, that is EBIT in short, that is rupees 1,20,000. What you call profit, the technical term uses earning before interest and tax, that is profit before deducting interest and before deducting tax. Now here I have taken three situations of debt and using debt and equity fund. In situation 1, you have seen the debt fund used in the organization is nil, that is zero, means the whole capital is funded from equity capital or equity source. In situation 2, rupees 4 lakhs is debt fund, 6 lakhs is equity fund. In situation 3, 6 lakhs is debt fund and 4 lakhs is equity fund. So gradually there you have seen an increase in the use of debt fund. Now we will see the effect or the impact on earning per share. The first situation, our earning before interest and tax was rupees 1,20,000. Now from here you have to deduct the amount of interest. So amount of interest, for calculating amount of interest, you need to take this percentage rate of interest 10%. On what amount you will calculate this? On the debt fund amount. But in situation 1, you have seen the debt fund is nil, so interest will be also 0. Now this amount is earning before tax and earning before tax and after interest, but actually there is no interest in this situation. Now calculate the tax. The rate was 30%. This 30% you have to calculate on this amount, this earning before tax, rupees 1,20,000. So 30% on 1,20,000 is 36,000. Now this rupees 84,000, this is earning after tax. I have written EAT, earning after tax. Now for calculating EPS, that is earning per share, you need to divide this amount, that is 84,000, by total number of shares employed. This 84,000. Now in this side I am writing the number of shares. So in situation 1, what is the number of shares? Assume the share prices is of rupees 10. So total equity fund is 10 lakhs. So if the share price is rupees 10, then the number of shares you'll get is 1 lakh share. Now for calculating earning per share, you need to divide earning after tax by the number of share. The number of share in this case is 1 lakhs. So you will get 0.84. Now see the second situation. This one. EBIT, that is earning before interest and tax, is 1,20,000. Interest, for calculating interest, you need to consider this tax interest rate 10%. On what amount you will calculate? On the debt amount. So in situation 2, the debt amount is 4 lakh. So 10% on 4 lakhs is 40,000. So earning before tax is 80,000. Tax 30% on this amount, 80,000, is 24,000. Earning after tax is rupees 56,000. Now in this case, EPS 56,000 divided by total number of shares. Now here you see total number of share is 60,000. As I said, you need to divide the amount of equity capital by the price of share. Price of share was 10 rupees 10. So 6 lakhs divided by 10, so it is 60,000 shares. Earning per share is 0.93. Now see, there is an increase, isn't it? Here in situation 1 it was 0.84, in situation 2 it is 0.93, and the difference is that in situation 1 debt fund is nil, in situation 2 debt fund is 4 lakh. Now again you see situation 3, calculation in the same procedure. EBIT 1,20,000, interest amount 10% on this amount 6 lakhs, so this is 60,000. Earning before tax is 60,000. Tax 30% on 60,000. So this is earning after tax 42,000. Now calculate the EPS. Rupees 42,000 divided by number of share. So here in this case the number of share is 40,000. So 42,000 divided by 40,000, and the earning per share you will get is 1.05. Now in all the three situations I have calculated earning per share. You see the effect, or you see the difference. Here it was in situation 1 0.84, in situation 2 it is 0.93, in situation 3 it is rupees 1.05. Now you need to see, with gradual increase in the use of debt fund, in situation 1 nil, EPS is 0.84. In situation 2 debt fund is rupees 4 lakh, earning per share is 0.93. So it is a higher amount than 0.84, isn't it? In situation 3 debt fund is rupees 6 lakhs and earning per share is rupees 1.05. So gradual increase in the earning per share. So why this happen? This happened because of increased use of cheaper fund or cheaper capital in the total capital of the organization. Now there are mainly two reasons debt fund is considered cheaper. One is that irrespective of the amount of profit earned by the organization, the rate of interest remain fixed. There is a fixtures. So that is an advantage for the organization if the organization is earning high profit. Okay. Now when I say high, there is a relative term. On what context it is high? So here you have to see that you find out the return on investment. I have written ROI, return on investment. To calculate return on investment, you need to divide EBIT by total capital employed. So EBIT in this case is 1,20,000 and total capital is 10 lakh into 100. So what is the amount? What is the return on investment? Return on investment is 12%. Now this return on investment is greater than the interest rate, or what we are saying is cost of debt. As we are discussing that debt is considered as cheaper because they are having fixed rate of interest. And another advantage is that interest is deducted before tax. Okay. Interest is deducted before tax. See here in the calculation. Okay, first we have calculate interest and after that only we have calculate tax, and because of that the firm is gaining the advantage. Okay, because in this case you have seen the tax is, though the rate is same in all the situation, the tax they gar is rupees 36,000. In this case it is 24,000. In this case it is 18,000. So there is a decrease in tax. And that advantage is also gaining because of the use of debt fund in the capital of the organization. So this situation is called favorable financial leverage. The organization is able to get the benefit of using low cost fund or cheaper source of fund. And in this case, the cheaper source of fund is debt fund. So this is the crux of using cheaper source of fund in the capital structure, or this we are calling as financial leverage and trading on equity. So in our next example, I will show you the impact of using debt fund more but in an opposite direction. Means when this return on investment is lower than cost of debt, in that case earning per share of the organization decreases. Thank you.